Imagine a company that just watched like 8% of its paying customers literally walk out the door.
Yeah, which is a massive hit.
Right. And then imagine that same company just deliberately forfeited $60 million in short-term revenue, just, gave it up. Willingly. And they're actively introducing friction into an app that was like historically famous for being completely frictionless.
It is wild to watch.
But here's the crazy part. Imagine that same company is simultaneously generating over $1 billion in free cash flow and has, never been more profitable.
Right.
Today, we are looking at the bizarre, highly lucrative, and honestly deeply contradictory paradox that is Match Group. Ticker symbol, MTCH.
Yeah, it's arguably one of the most fascinating diagnostic challenges in the whole consumer tech sector right now.
Absolutely.
Because the market is staring at this asset and completely disagreeing on what it actually is,
Right, like, are we watching the terminal decline of a legacy social product, something that just lost all its cultural relevance?
Exactly. Or, on the flip side, are we looking at this masterclass in corporate rehabilitation, where management is, intentionally taking the medicine today so they can build the sustainable, highly profitable cash machine for tomorrow?
And that is exactly the tension we're exploring in this deep dive. Because if you're a retail investor holding Match Group in your portfolio, or, maybe you're sitting on the sidelines eyeing the current valuation, our mission today is to slice straight through all the corporate jargon from their Q4 2025 earnings call.
You have to cut through the noise.
Right. We're keeping it data forward, very opinionated, and we're looking under the hood. We really want to figure out if this whole, Tinder turnaround is a legitimate pivot, or if this stock is just the ultimate value trap disguised by some clever financial engineering.
Yeah, and to do that, you really have to look past the top-level spin.
Right.
Because the narrative around this company has honestly completely fractured over the last few years. I mean, Match Group used to be the absolute darling of the hyper-growth tech era.
Oh, yeah. Investors priced it, assuming it would just conquer the globe and grow its top line forever.
Exactly. And now the business is behaving in a totally different way.
Yeah.
Like the mechanics of how they make money and, more importantly, how they allocate that money have just fundamentally shifted.
So to understand that shift, we need to start with the headline numbers.
Let's do it.
Let's look at the financial foundation they just reported for the end of 2025. What did the actual revenue look like for the fourth quarter?
Well, in Q4, Match Group brought in total revenue of $878 million.
Okay.
And on a strictly reported basis, that is up 2% year over year.
2%. That's not exactly hypergrowth.
No, not at all.
Yeah.
But management was very quick to point out that on a foreign exchange neutral basis, or FX neutral, the top line revenue is completely flat. Zero growth. And if you zoom out to the full year of 2025, they hit $3.5 billion in total revenue, which again is completely flat compared to the previous year.
Okay, wait, I want to make sure we don't just gloss over that term.
Sure.
Because for you listening, if you're managing your own portfolio and maybe you aren't steeped in corporate accounting, we need to break down what foreign exchange neutral actually means here.
Yeah, it's super important.
Like, why does management insist on highlighting it when the reported number actually looked slightly better at 2%?
Right. So it's a critical concept for basically any multinational company. You have to remember, Match Group generates a massive portion of its revenue outside the U.S.
Right. Like all over the world.
Exactly. So users in Europe are paying for their subscriptions in euros. Users in Japan are paying in yen. But Match Group is a U.S.-based company.
So they have to convert it all back.
Exactly. When they report earnings to Wall Street, they have to translate all those euros and yen back into U.S. dollars.
And currency values are obviously constantly fluctuating.
Right. They never sit still. So if the U.S. dollar becomes exceptionally strong relative to the euro, then those euros that Match Group earned in France or Germany, they suddenly buy fewer U.S. dollars.
Right.
So the company might have actually grown their subscriber base and increased local revenue in Europe, but when they translate it back to dollars for the report, it looks like they shrank.
Ah, I see.
So management uses this FX neutral metric to tell investors, look, if we strip away the unpredictable swings in global currency rates, the actual underlying consumption of our product remained perfectly flat.
They want you to judge the business on what they can actually control.
Exactly, not on macroeconomic currency shifts.
That makes perfect sense.
Yeah.
So, all right, The top line is stalled. The engine isn't pulling any more freight than it did last year.
Right.
But here is the jarring juxtaposition from the data. The revenue hasn't budged, but the profitability metrics are absolutely soaring.
It's crazy.
Yeah, look at Q4 adjusted EBITDA. It came in at $370 million. That's up 14% year over year.
Yeah.
That represents a 42% margin.
Which is just a staggering level of profitability for a company that, frankly, isn't growing its sales at all.
And again, let's translate the jargon for the listener. We see adjusted EBITDA in almost every single tech earnings report.
Oh, constantly.
So what is the specific mechanism here? Like, why focus on this specific profit metric instead of just looking at net income?
Well, adjusted EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's quite a mouthful.
It is.
Yeah.
And the adjusted part basically strips out unique one-time items. Essentially, it is the core cash profit the business generates from its actual day-to-day operations.
Okay, so it completely removes the accounting noise.
Precisely. It ignores things like the interest they pay on corporate debt.
Yeah.
Or the taxes they owe the government.
Right.
And the depreciation of their physical assets. In tech companies, it also frequently strips out stock-based compensation, which is huge.
Oh, yeah, that's a big one.
Right. But more importantly, for Match Group this quarter, it strips out one-time anomalies. Like in this report, they mentioned the sale of an office building in Los Angeles.
Okay.
And some specific legal settlements. If you leave those in, the profit looks artificially high or low for just a single quarter.
That makes sense. So adjusted EBITDA tells you, look, is the core machinery of this business, the actual software and the subscriptions, is that machinery actually making money?
And for Match Group, I mean, the answer is undeniably yes. A 42% margin means that for every $100 a user spends on the app, the company is keeping $42 in pure operational profit.
Which is incredibly rare. Very, very few businesses in the world operate at a 42% margin.
Yeah, that's wild.
It basically indicates that the variable cost of delivering their product is just incredibly low. Once the software is built, it costs them virtually nothing to allow one more user to swipe right.
Right. The margins on software are just huge.
Exactly. It proves that the business is a cash-generating machine, even if that top-line growth is completely stalled out.
Which brings us to the capital return program, because honestly, this is where the plot really thickens for you as a retail investor.
Oh, for sure.
They have this massive pile of cash, over $1 billion in free cash flow for the year. And what they're choosing to do with that cash, it kind of fundamentally redefines what kind of company this is.
It really does.
They announced they reduced their diluted shares outstanding by a massive 7% just in 2025 alone.
Yeah.
And if you look back over the last year, they've retired 20% of the company's total stock.
It's massive.
And on top of that, they increased their quarterly dividend by 5% to 20 cents per share.
The magnitude of that share buyback, honestly, it cannot be overstated. You are watching a company fundamentally alter its identity in real time.
Right.
Because in the past, tech companies, especially in social media, they took every spare dollar of cash flow and aggressively threw it at customer acquisition or, wild geographic expansions or experimental new features.
The whole growth at all costs mantra.
Exactly. But Match Group is doing the exact opposite. They are saying, look, we have so much free cash flow that we are going to use 108% of it when you factor in cash on hand and debt adjustments to buy back our own stock and pay cash dividends to our shareholders.
Let me make sure I understand the mechanics of this, because buying back 20% of the company sounds huge on paper. But what does it actually mean for you if you're holding, say, 100 shares of MTCH in your brokerage account?
Okay, think of the company's total earnings as a giant pizza.
Okay, I like pizza.
Right. So if there are fewer slices of pizza overall, each remaining slice represents a larger percentage of the whole pie.
Right.
When Match Group goes into the open market and uses its cash to buy 20% of its own shares and permanently retires them, they're effectively shrinking the denominator.
So my 100 shares suddenly represent a larger ownership stake in the whole business without me having to invest a single extra dollar.
Exactly. Even if the company's total net income remains completely flat, the earnings per share, the EPS metric that Wall Street obsesses over, it will mathematically increase simply because those earnings are divided among fewer shares.
Oh, okay.
It is a highly efficient way to return value to the investor when you don't have an obvious internal project that requires massive capital investment.
Okay, so I understand the math, and it sounds great on paper. You get a larger piece of this highly profitable pie.
Yep.
But this is where I start to get deeply nervous.
Okay, why?
Because If I'm looking at this objectively, Match Group right now operates less like a visionary Silicon Valley tech startup and more like a mature utility company.
Oh, that's an interesting comparison.
Like a regional water or electric monopoly, you know? They're pumping out cash, they are incredibly profitable, and they're buying back stock to reward the legacy shareholders. But isn't aggressively shrinking your share count by 20% just a financial magic trick? Like, is it a convenient shield designed to mask the uncomfortable truth that your core product, the very engine that generates the cash, has fundamentally stopped growing?
And that is the exact tension. That is the primary debate happening on literally every trading desk right now.
Because it can't last forever.
Right. Financial engineering is powerful, but it cannot fix a dying product. You can mathematically boost your earnings per share by shrinking the share count, but you can only play that game for so long.
Eventually, reality sets in.
Exactly. Eventually, if the underlying revenue continues to shrink, it catches up with you. You cannot cut your way to long-term sustainable growth.
So the buybacks are essentially buying management time.
Exactly. It pays you, the investor, to be patient while management takes the engine apart and tries to fix the misfiring cylinders.
Right. Yeah.
But to determine if that engine is actually repairable or if it's permanently broken, we have to look past these consolidated company-wide numbers.
Because it's not just one app.
No, Match Group is a portfolio company.
Right.
But the entire narrative is really dominated by two massive applications that are currently moving in completely opposite directions.
It's the tale of two apps.
Exactly.
So let's look at the sick patient first. Let's talk about Tinder, because Tinder is the historical cash cow of this entire operation.
It built the company.
Yeah. And the numbers here are incredibly complex. Q4 direct revenue for Tinder was down 3% year over year, coming in at $464 million. But the underlying user metrics are what really jump off the page here. The number of payers, like the users actually pulling out their credit cards to buy premium subscriptions or a la carte features, declined by 8%.
Yeah.
They are down to 8.8 million paying users.
That is a very significant drop in payer penetration. And yet, simultaneously, the revenue per payer, or RPP, actually grew by 5% to $17.63.
Okay, you have to make that make sense to me.
It sounds contradictory.
Right. The total number of people paying you dropped by 8%, but the revenue you extract from the people who stuck around increased by 5%. Are they just squeezing their most loyal and maybe most desperate power users for more money to artificially inflate the revenue, just to mask the fact that everyone else is abandoning the platform?
Look, what you're describing is a well-documented phenomenon in subscription businesses. It's known as the power user squeeze.
The power user squeeze.
Right. When revenue per payer goes up, but total payers go down, it almost always indicates that the casual users, you know, the people who maybe bought a cheap weekend boost or something, they have churned out of the ecosystem.
They're just gone.
Gone.
Yeah.
So you are left with a concentrated core of power users who are deeply entrenched in the platform. And those users are willing to pay for the highest, most expensive subscription tiers, like Tinder Platinum.
But you can only squeeze that lemon so hard.
Right.
Eventually, even the power users get fatigued, or they actually find a partner and you run out of juice.
Precisely. And management is acutely aware of this dynamic. They know they absolutely cannot rely on price increases to offset user churn forever.
Yeah.
Which is exactly why the CEO, Spencer Raskol, who took over roughly a year ago, has initiated what they're explicitly calling a holistic turnaround strategy for Tinder.
And the mechanics of this turnaround strategy are pretty wild.
Yeah, they are.
It runs entirely counter to traditional corporate behavior. Management is intentionally taking short-term revenue hits. Yeah. They outlined a massive $60 million user giveback budget bracketed across 2025 and 2026. Like, they are deliberately choosing to make less money right now in order to improve the user experience.
Yeah.
So walk me through the actual user experience. What does a revenue giveback actually look like on my phone?
Okay, so the clearest example management provided on the call revolves around this new feature called FaceCheck.
Which is a biometric verification tool, right?
Correct. It uses facial recognition technology to prove that you are an actual human being and you actually look like the photos on your profile.
So no more catfishing.
Exactly. It's designed to eradicate bots, scammers, and catfishing from the ecosystem completely.
Right.
Now, from a purely financial perspective, Introducing this kind of friction into an app is incredibly dangerous.
Oh, I'm sure.
When they first rolled FaceCheck out in early test markets like Canada, I believe it caused an immediate 10% hit to top-line revenue in that specific market.
Like 10% drop, just from verifying a photo. Yeah. Why? Are there really that many scammers buying premium tiers, or do real people just hate the friction of scanning their faces?
It is a combination of both, actually, but primarily the latter. In consumer software design, friction is the absolute enemy of conversion.
You want it to be seamless.
Right. Anytime you ask a user to stop what they are doing, hold their camera up, get the lighting right, and scan their face, a significant percentage of them will simply close the app.
They just give up.
Yeah, they lose momentum.
Yeah.
And if they aren't engaging with the app, they aren't seeing ads, and they certainly aren't hitting the paywall to buy a premium subscription.
Wow.
So a 10% revenue drop is usually a catastrophic, career-ending metric for a product manager. In most companies, a feature that destroys 10% of revenue is killed immediately.
But Match Group didn't kill it.
No, they didn't. They kept it alive and they iterated. They spent months tweaking the user interface, smoothing out the onboarding flow, really explaining the value proposition to the user better and making the technology faster.
They pushed through the pain.
Exactly. And over several quarters, they managed to reduce that revenue hit from 10% down to just 1%.
Okay, a 1% hit to revenue is palatable if it achieves a broader strategic goal.
And look at the payoff for that 1%.
Right.
By rolling out FaceCheck globally and enduring that slight friction penalty, they cut user interactions with bad actors by 50%.
That is massive.
Half of the bots, half of the scammers just gone from the ecosystem entirely.
It's an ecosystem-defining improvement. Because for Gen Z, who consistently cite trust, safety, and authenticity as their absolute biggest barriers to using dating apps, cleaning up the platform is paramount.
Exactly.
Management essentially made a calculated trade. They traded 1% of their immediate revenue to drastically improve the long-term health and reputation of the digital environment.
Yeah, that's exactly what they did.
So it sounds like Tinder is in rehab. Like they are deliberately detoxing the app. They're stripping out the artificial sugar highs of bot engagement and short-term monetization tricks to try and build a healthier baseline.
That's a great way to put it.
And the laboratory where they are testing all these rehab treatments is Australia.
Yes.
They spent a huge portion of the earnings call talking about Project Aurora, which was basically their initiative to flood the Australian market with every single product improvement and new marketing tactic all at once in the fourth quarter.
Yep, the whole package.
And the metrics they're bragging about coming out of this Australian test are, well, they're interesting.
It's very interesting.
They kept hammering on a metric called sparks. What exactly is the mechanism of a spark?
So the introduction of the spark metric represents a pretty profound shift in how Match Group evaluates its own product.
How so?
Well, for over a decade, the defining metric for Tinder was the match. Two users look at each other's profiles, they both swipe right, and boom, the app tells you it's a match.
Right, it was the dopamine hit that literally built the company.
Exactly. But a match is completely superficial.
Because it means absolutely nothing if neither person actually initiates a conversation.
Right. Or if one person says, hey, and the other person never replies. Management has finally publicly acknowledged that the superficial match is no longer a valid proxy for user success.
The ecosystem just got too noisy.
Yeah. So they introduced sparks. A spark is rigidly defined as a six-way conversation.
A six-way conversation.
Yes. Person A sends a message, person B replies, A replies, A replies, B replies.
Now that requires actual sustained human intent.
Right. It indicates a genuine, engaged interaction. They believe a spark is a far more accurate leading indicator of real-world connection.
Okay.
And the data from the Project Aurora test in Australia is showing signs of life based on this metric.
What are the numbers?
So in December 2024, total sparks in Australia were declining at a rate of 14% year over year. The ecosystem was dying rapidly.
Wow.
But by December 2025, after rolling out Project Aurora, that decline had slowed to just 8%. Furthermore, spark coverage, which they define as the percentage of total active users who actually achieve a spark in a given month, that metric completely reversed its trajectory, going from down 2% to up 2%.
Okay, I have to step in and aggressively challenge this logic.
Oh, I thought you might.
Because if I am an analyst sitting on Wall Street, this sounds incredibly convenient. Management is hyping up a brand new metric called six-way conversations, and they are celebrating the fact that it is only down 8% in a test market, while their actual global paying users are also down 8%.
Right, the optics are weird.
Yeah. If I am an investor, I cannot deposit a six-way conversation into my brokerage account. Why shouldn't I view this Spark metric as a desperate sleight of hand? Isn't this just moving the goalpost because the actual financial metrics look terrible?
Look, it is an entirely valid, highly skeptical perspective, and honestly, it is exactly what the bearish analysts are arguing right now.
Because it feels like spin.
It does. When a company invents a new metric while the revenue metrics are falling, you absolutely must be extremely cautious.
Yeah.
However, if we step back and analyze the fundamental underlying logic of consumer social applications, management's focus on Sparks makes architectural sense.
How?
Because you simply cannot monetize an empty room. And you definitely cannot monetize a room full of people who are having a frustrating, terrible time.
Fair point. If the party is dead, no one's buying drinks.
Precisely. Top of funnel engagement has to heal before payer growth can fundamentally return.
Okay.
Think of the user journey within a social app as a very deliberate multi-stage funnel. At the very top, you have new account registrations.
Right.
Below that, you have monthly active users, or MAU, which measures retention. Below that, you have engagement metrics, which is where Sparks lives. At the very bottom of the funnel, you have payers.
The people who have derived enough value to actually hand over their credit card.
Right. And as the CEO noted on the call, when you are trying to turn around a distressed social product, it is mathematically easiest to impact the bottom of the engagement funnel first.
Because they're already in the app.
Exactly. You tweak the recommendation algorithm to show better profiles. You force FaceCheck to remove the spam bots. And suddenly, the people who are currently sitting in the room start having slightly better interactions. The Sparks metric goes up.
So the product instantly feels better to the people who are already actively using it.
Exactly. And what happens mechanistically when the product feels better? Retention improves. Users do not delete the app in a fit of frustration after 2 days.
Right.
When retention improves, your monthly active users metric stops bleeding and begins to stabilize.
Okay, I see where this is going.
And when MAU stabilizes, organic word of mouth improves in the real world, which eventually drives new registrations at the top of the funnel.
It's a chain reaction.
Yes. Only when that entire cycle is humming smoothly again do users feel confident enough in the platform's utility to pull out their credit card and become a payer.
It's not a distraction.
No. Tracking Sparks is not just corporate spin. It is a necessary mechanical leading indicator. If Sparks aren't growing, payer growth is mathematically impossible.
It's the canary in the coal mine, but like working in reverse. It is the very first biological sign of life in a recovering patient.
That's a great way to put it.
And speaking of signs of life, there was another massive metric from the Australian test that they pointed to: female monthly active users.
Yes, this is key.
Overall, MAU in Australia improved by 3 percentage points, but female MAU improved by 5 percentage points. Break down the mechanics of this for me. Why does female MAU matter disproportionately in the dating app ecosystem? Like, why is management laser focused on that specific demographic?
This dives into the fundamental behavioral economics of dating platforms. These applications are essentially digital two-sided marketplaces, much like Uber matching riders with drivers or Airbnb matching guests with hosts.
Right.
But in the dating market, historically, the demand side, which is predominantly men, heavily outweighs the supply side, which is predominantly women.
It is a massive imbalance of intent and behavior.
Correct.
Yeah.
Men typically swipe more frequently, engage more aggressively, and honestly have a higher propensity to pay for premium features.
Okay.
But women are the absolute cornerstone of the network effect. If the digital environment becomes toxic, unsafe, overrun with bots, or simply feels culturally irrelevant, women are the first to leave the platform.
And the mechanics of that collapse are probably pretty swift.
Oh, incredibly swift. When the women leave, the men quickly realize they have no one to match with. Engagement plummets, retention collapses, and finally, monetization just vanishes.
It is the digital equivalent of a nightclub.
Exactly.
If the club has a terrible, aggressive vibe and women just stop showing up, the guys are absolutely not going to pay the $100 VIP cover charge just to stand around an empty room.
That is the perfect analogy.
Yeah.
And network effects are incredibly powerful, but they work in both directions. A positive network effect builds a monopoly, but a negative network effect creates a death spiral. Management knows that to stop the death spiral, their entire product roadmap must be focused on improving the specific experience for female users, knowing that securing the supply side automatically heals the entire ecosystem.
Which perfectly explains the push for safety features like FaceCheck.
Exactly. And they are implementing deeper AI recommendation algorithms to ensure women see higher quality, more relevant profiles rather than just an endless queue of random users.
Right.
But the most fascinating mechanical shift in this strategy, honestly, is the rollout of a brand new feature called Double Date.
Yes, let's look at the data on Double Date because it is kind of shocking.
It really is.
Management stated that 1 in 4 Gen Z users in the Australian test market are already using it. That equates to 10% of their total active users in that country.
Which is huge for a new feature.
Right. For a brand new user interface feature to achieve a 10% adoption rate that quickly is massive. So what is the actual mechanism of Double Date, and why is it resonating so powerfully with this specific demographic?
Well, Double Date attacks a core systemic problem in the industry right now, which is severe dating fatigue.
People are just burnt out.
Completely. Gen Z, as a cohort, is exhausted by the high-pressure, single-player gamified swipe mechanic that Tinder basically invented a decade ago. It feels isolating. It feels transactional. It feels like a job interview.
It lacks humanity.
Right. So Double Date fundamentally alters the architecture of the app by bringing the social graph back into the experience.
How does it work?
The mechanism is super simple. You link your profile with a friend's profile. You then browse the app together as a pair, and you match with other pairs of friends.
Oh, wow.
It shifts the dynamic from a high-stakes, one-on-one romantic audition into a low-pressure, fun communal activity. You are sitting on the couch with your friend, laughing at profiles together, chatting in a group message, and it just takes the immense pressure off that initial meetup.
It completely redefines the value proposition.
Yeah.
It changes Tinder from a high-stakes hookup app into a low-stakes social discovery tool.
Yeah.
And from a growth perspective, it's brilliant because it has an inherent viral loop built right in. Like, you literally have to invite a friend to download or open the app to use the feature with you. It drives organic acquisition without spending marketing dollars.
It is a textbook example of product-led growth. And it proves that when you reduce the friction of anxiety and introduce a multiplayer mechanic, the Gen Z demographic is still totally willing to engage with the brand.
Okay, so if we synthesize the Tinder narrative, the patient is in rehab.
Very much so.
They're making agonizingly slow structural changes. They are trading short-term cash for long-term ecosystem health, and they are seeing very early fragile signs of stabilization in their test markets.
That's a fair summary.
But if we walk across the hall in the Match Group portfolio, we find the golden child, Hinge.
Yeah, Hinge is operating in a completely different universe of momentum right now.
The numbers are staggering. Q4 direct revenue for Hinge was up 26% year over year, hitting $186 million.
Insane growth.
Yeah, and the number of payers jumped 17% to 1.9 million. Revenue per payer grew 8%. It has achieved this massive algorithmic momentum, and it is expanding globally at just a breakneck pace.
Right.
They specifically highlighted their dominance in Europe, Mexico, and Brazil. Why is Hinge so immune to the fatigue that is suffocating Tinder?
The mechanism of Hinge's success really lies in its incredibly precise market positioning.
Okay.
To understand this, we have to look at an internal strategic framework that Match Group uses, which they call the GM model. GEM stands for the different categories of user intent.
What are the categories?
Well, at one end of the spectrum, you have fun. This is where Tinder lives. It is designed for high-volume, social, low-pressure connection. But at the other end of the spectrum, you have focus. This is the category Hinge dominates.
Right, the dating app designed to be deleted. That is their whole tagline.
Exactly. Every single mechanical design choice in Hinge is built for intention and depth. Yeah. You don't just swipe on a photo. You have to physically type a comment on a specific prompt or answer a specific question on someone's profile to initiate contact.
Which introduces friction.
It forces friction. But in this case, the friction is a feature, not a bug, because it actively filters out the casual users.
And the data supports this shift in consumer behavior. Apparently, 80% of Gen Z singles report that they are actively seeking meaningful long-term relationships, which is actually a much higher rate of serious intent than older generations exhibited at the same age.
It's surprising but true.
Gen Z doesn't just want to endlessly swipe for a cheap dopamine hit. They actually want the focus category.
Yes. The cultural zeitgeist has really shifted toward intentionality. And from a purely financial perspective, because Hinge solves a deeper, more emotionally significant problem for the user like, find a life partner rather than just a Friday night date, it monetizes beautifully.
People will pay more for that.
Exactly. The behavioral economics dictate that a user is willing to pay significantly higher subscription fees and tolerate higher pricing tiers when the perceived value is a serious long-term relationship.
And that product market fit is translating into explosive geographic expansion. Let's look at the mechanics of their rollout.
Let's do it.
They launched in Europe in 2022. In roughly 3 years, they went from 200,000 users to 3.3 million monthly active users across their European markets.
Huge numbers.
They are now the top downloaded dating app in 12 different European countries. Management expects to generate over $100 million in direct revenue just from Europe in 2026.
And they are aggressively porting that exact same playbook into Latin America and Asia.
Yeah.
They launched localized versions in Mexico and Brazil in the second half of 2025. It is already the second most downloaded dating app in those countries. They announced plans to move into 3 additional LATAM markets, as well as India, in 2026.
Okay, the India data point is the most fascinating piece of this puzzle to me.
It's incredible.
Management noted that they already have 1 million monthly active users in India, and that user base is growing at 40% year over year. But here is the kicker. They are achieving that growth without any marketing spend. How is that even mechanically possible?
It speaks to the immense power of organic word of mouth in culturally dense markets. Look, India is undergoing a massive cultural shift regarding dating and relationships among the younger generation in urban centers.
Right.
But the cultural nuances still demand a high level of intentionality and respectability. The gamified, highly casual nature of Tinder doesn't perfectly align with those shifting but still traditional values.
But Hinge does.
Right. Hinge's designed to be deleted ethos, focusing on prompts and deep profiles, provides a socially acceptable, highly intentional platform that resonates perfectly with the emerging Indian middle class.
That makes total sense.
When a product perfectly matches a cultural moment like that, it creates a viral loop that completely bypasses traditional marketing budgets.
Organic traction in a market with over 1 billion people. That is literally the holy grail for a consumer tech company.
It really is.
Management stated they expect Hinge to hit $1 billion in total direct revenue by 2027. So, for the retail investor, you have this incredibly complex, bifurcated dynamic.
Very bifurcated.
The core legacy product, Tinder, is shrinking but printing massive operational profits. The shiny new product, Hinge, is growing at 26% and expanding globally. But then we have the rest of the portfolio. They categorize this as evergreen and emerging, or E&E and Match Group Asia. What are the mechanics of what is happening over there?
Well, it is a highly complex segment, and right now, to be honest, it is acting as a significant drag on the overall growth of the company.
You're dragging it down.
Yeah. E&E direct revenue was down 7% for the year. This segment houses their affinity brands. These are specialized applications tailored to very specific demographic communities.
Like what?
For example, they own Trespa, which is targeted at Hispanic daters, BLK, targeted at Black daters, and Salams, which is explicitly designed for Muslim daters.
Which sit in that third category of their GZM model. We had fun, we had focus, and these apps sit in the familiarity category.
Exactly.
You are utilizing the app specifically to find someone with shared cultural, ethnic, or religious values.
Correct. But these affinity apps are currently facing severe audience headwinds. And CEO made a very astute observation regarding the fundamental product mechanics of these platforms.
What was it?
Well, if a user is downloading an app specifically to find someone of their exact religious background or cultural heritage, their intent is almost certainly aligned with the focus mindset.
Right, they aren't messing around.
Exactly. They are looking for a long-term, compatible partner who shares their core values. They are not looking for a casual fling.
So the user intent is high, but the product mechanism is wrong.
Exactly. For years, Match Group's primary growth strategy was simply to copy and paste the Tinder swipe interface. The deck of cards you sort left and right onto every single new app they bought or built.
Because it was easy.
It was cheap, it was scalable, and they knew exactly how to monetize it. But swiping inherently gamifies the experience in a way that directly contradicts the serious, intentional dating mindset required for an affinity app.
It feels disjointed. Like, if I am looking for a partner who shares my deep religious convictions, I don't want to judge them based on a split-second swipe of a single photo.
No, of course not.
I want context.
Precisely. The user interface was actively fighting the user intent. So management is currently undertaking massive digital surgery. They are systematically ripping out the swipe mechanic in these affinity apps and replacing it with what they call a vertical profile model.
Walk me through the mechanics of a vertical profile model. What does that actually look like?
Well, instead of a stack of cards where you are forced to make a binary yes or no decision on a single photo before you can see the next person, a vertical model is a continuous scrolling feed.
Like social media.
Yeah, it operates much more like scrolling through TikTok or an Instagram profile. You scroll down through a user's photos, their prompts, their answered questions, and their detailed biographical information.
You have the whole picture.
Right. You absorb the full context of their personality and values before you make a decision to engage.
That sounds like a much better product experience, but why is it causing revenue to drop 7%?
Because fundamentally, changing the core user interface of an established application causes immediate short-term chaos.
Oh, because of the users.
Yeah. Users build muscle memory. When you change how the buttons work, users get confused, they get frustrated, their engagement drops momentarily, and consequently, revenue takes a hit.
They just leave.
Right. Management is intentionally breaking the apps in the short term, betting that aligning the interface with the actual user intent will eventually regain product market fit and drive sustainable growth.
And it isn't just self-inflicted UI disruption dragging this segment down. They also highlighted external regulatory friction in their Asia portfolio, didn't they?
Yes. Specifically regarding an application called Azar, which is a massive video-based social discovery app. Currently, Azar is facing regulatory blocks in Turkey, completely shutting off a significant revenue stream.
Wow.
So when you combine the internal disruption of rewriting the affinity apps with the external geopolitical shocks in the Asian markets, you get a portfolio segment that is actively bleeding.
Okay, let's synthesize everything we have covered so far, because we have a lot of moving parts here.
We really do.
We have Tinder in rehab, deliberately giving back revenue and introducing friction to heal the ecosystem. We have Hinge achieving algorithmic momentum and conquering the globe.
Yep.
And we have the affinity apps undergoing massive chaotic UI surgery. Knowing all of these underlying mechanics, how is management actually forecasting the financial reality for the next 12 months? Let's break down the management guidance, because this is what Wall Street truly cares about.
The guidance is really where the strategic narrative collides with the mathematical reality for the retail investor. And for 2026, the guidance is incredibly sobering. They explicitly told Wall Street they expect full year 2026 revenue to land between $3.41 billion and $3.535 billion.
Which means at the midpoint, revenue will be completely flat year over year again.
Yes.
Zero top-line growth projected for the next 12 months.
Zero growth. Furthermore, they are projecting their 2026 adjusted EBITDA margins to compress, landing at approximately 37.5%.
Wait, make that make sense? Didn't we just celebrate the fact that Q4 2025 was operating at a massive 42% margin?
We did.
So if top-line revenue is going to be perfectly flat, why is profitability shrinking by over 400 basis points? Where's that cash going?
Because management has officially designated 2026 as a transition year, a massive reinvestment year.
Reinvestment, okay.
They're deliberately taking hundreds of millions in cash flow that would normally drop straight to the bottom line as profit, and they are pouring it aggressively back into the business to accelerate the turnaround strategies we just discussed.
Right.
And what makes this transition year so unique is that they have acquired a massive, unexpected war chest to fund it.
Are you talking about the App Store windfall?
Exactly. To understand the mechanics of this, we have to look at the broader geopolitical battle occurring in the tech industry.
Give us the background.
For the last 15 years, if a consumer tech company wanted to sell a digital subscription on an iPhone or an Android device, they were forced by Apple and Google to use the native proprietary billing systems built into the app stores.
And Apple and Google extracted a mandatory 30% tax on every single transaction.
It was a monopoly toll booth.
It was an inescapable tax on the entire mobile economy. But thanks to massive years-long antitrust lawsuits, most notably the Epic Games versus Apple lawsuit, combined with regulatory crackdowns from the European Union, the walls of that walled garden have finally been breached.
Yeah, it's a huge shift.
Match Group, along with other developers, is now legally allowed to implement alternative payment links. They can direct users to a secure third-party web browser to process their credit card, completely bypassing the Apple and Google billing systems.
And bypassing the 30% tax.
Precisely. By capturing that massive spread in margin, Match Group expects to save approximately $110 million in pure cash during 2026 that they previously would have handed over to Apple and Google.
That is a staggering windfall. $110 million just dropping out of the sky because of a shift in regulatory policy.
Under normal circumstances, Wall Street analysts would demand that entire windfall be returned to shareholders as pure profit, boosting that EBITDA margin even higher.
Oh, absolutely.
But Match Group's management is taking almost all of it and plowing it straight back into product development and targeted marketing.
Where specifically are they deploying that capital?
Well, they are boosting Tinder's marketing budget alone by $50 million, bringing the total Tinder ad spend to $230 million for the year.
Okay, but how are they deploying that $230 million? Because historically, Tinder's marketing strategy was defined by massive, flashy, top-of-funnel brand awareness campaigns.
Right.
They ran beautiful cinematic commercials.
Yeah.
They bought massive billboards in Times Square with slogans like, "It starts with a swipe." Are they just going to buy more billboards?
No, and this is a crucial mechanical shift in their strategy. They addressed it directly on the call.
What did they say?
Management ran a massive internal data analysis initiative they called Project Prism to rigorously measure the actual return on investment for every single ad dollar spent across their entire global portfolio.
And what did Prism find?
The data was undeniable. Top-of-funnel brand awareness marketing, the billboards, and the cinematic TV commercials is fundamentally broken for Tinder right now. It is yielding zero return.
Why?
Because Gen Z already knows exactly what Tinder is. Brand awareness is near 100%. The problem isn't that young people haven't heard of the app. The problem is that their perception of the app is overwhelmingly negative.
Right, they view it as toxic.
They view it as a toxic environment filled with bots. You cannot fix a toxic product perception with a glossy billboard.
So how do you actually deploy marketing dollars to change a deeply entrenched cultural perception?
You abandon brand awareness entirely and shift to bottom-of-funnel performance marketing. Specifically, they are deploying that capital into user-generated content, or UGC, on platforms where Gen Z actually lives, like TikTok and Instagram.
Walk me through the mechanics of a UGC campaign. What does that actually look like to a user scrolling their feed?
Instead of a highly produced commercial, Match Group pays micro-influencers and real younger users to film themselves on their iPhones talking authentically about the new features.
Oh,
you are scrolling TikTok and you see a video of a 22-year-old saying, "Hey, I was totally burned out on dating apps, but my friend dragged me onto Tinder's new double date feature, and we actually had a hilarious time."
Or mentioning the safety features.
Right. I re-downloaded Tinder, and the bots are actually gone because they force you to scan your face now.
It relies on peer-to-peer validation rather than corporate messaging.
Exactly. It feels authentic. It directly targets the specific pain points of the demographic that abandoned the platform, and it proves that the ecosystem is actually healing. It is a highly targeted, highly measurable deployment of capital.
It sounds like they are literally taking one step backward on the income statement to jump 2 steps forward strategically.
Exactly.
They are betting $50 million of App Store savings on TikTok ads to convince a skeptical generation that the product is fixed. But, crucially, they do not expect immediate results.
No, they were very explicit in tempering Wall Street's expectations. They stated that they expect Tinder direct revenue to continue to decline at roughly 4% throughout 2026.
They're not out of the woods.
They are still actively executing the $60 million user giveback budget, and they are still rolling FaceCheck out globally, which carries that 1% friction penalty we discussed.
They are telling the market point blank, do not expect Tinder to grow in 2026. The entire goal of this transition year is simply to stabilize the bleeding. They want to get monthly active users to flat by the end of December, so that in 2027, the foundation is solid enough to finally return to sustainable growth.
And while Tinder undergoes this agonizing rehabilitation, Hinge will continue its aggressive march. Management expects Hinge's direct revenue growth to remain in the low to mid 20% range throughout 2026, accompanied by robust margin expansion.
Wow.
They are reinvesting a portion of the App Store savings into Hinge as well, but because the product market fit is already so dominant, they can allow a lot more of that revenue to drop straight to the bottom line as profit.
Okay, we have covered a massive amount of highly complex data here.
We really have.
We have flat overall guidance for the year. We have declining pairs on the legacy platform. We have explosive algorithmic momentum from the secondary platform.
Yep.
We have a massive influx of regulatory cash savings being plowed into TikTok marketing. And we have aggressive share buybacks, shrinking the outstanding stock by 20%.
So what's the verdict?
It is time to synthesize this entirely for the listener. We need an actionable, highly opinionated verdict. If you are an investor looking at MTCH today, what is the bottom line?
The overarching opinionated stance that we have to take based on all this data is a fundamental reclassification of the asset itself. Match Group is no longer a growth stock.
It's just not.
If you are an investor buying this equity today, expecting 30% year-over-year top-line revenue growth, hoping it behaves like a hot sauce company or an AI infrastructure play, you are in the wrong place.
You will be very disappointed.
Match Group is officially, undeniably, a value stock and a turnaround play.
Let's break down the thesis for both sides. Give me the bullish signal first. Why would a rational investor buy or hold this stock today, knowing revenue will be completely flat for the next 12 months?
The bullish thesis rests entirely on the concept of the coiled spring, powered by immense cash flow. If you fundamentally believe in management's turnaround strategy, if you believe that forcing FaceCheck, ripping out the swipe mechanic infinity apps, deploying Double Date, and running authentic TikTok UGC ads will eventually heal the ecosystem and bring Gen Z back, then you are looking at a highly profitable cash cow currently trading at a massive discount.
Because of the financial engineering.
Exactly. Management retired 20% of the company's total stock over the last year. They have the free cash flow to execute a similar massive reduction in 2026.
Which is huge for shareholders.
Right. While you wait for Tinder's MAU metric to finally turn positive in 2027, you are being paid a rising quarterly dividend. More importantly, your percentage ownership of the company's future profits is growing larger every single quarter through those massive buybacks. Mm-hmm. Furthermore, the market is so hyper-fixated on Tinder's struggles that they are mispricing Hinge. Hinge is a certified rocket ship.
It absolutely is.
The eventual monetization of Hinge's massive organic footprint in Latin America and India offers tremendous upside that simply isn't factored into the current stock price. If they shrink the share count by another 10 or 15%, and then Tinder finally flips back to even modest revenue growth in 2027, the free cash flow per share will just skyrocket.
And that leads to a re-rating.
Exactly. The stock would theoretically experience a massive re-rating from Wall Street, meaning analysts will fundamentally increase the multiple they are willing to pay for those earnings.
It is a classic value investing setup. You buy a distressed asset with incredible cash flows, wait for the narrative to shift, and profit from the multiple expansion.
Yep.
Okay, but what is the bearish signal? Give me the absolute nightmare scenario for this company.
The bearish signal is the terrifying possibility that the X-ray is terminal. The nightmare scenario is that despite the $230 million marketing budget, despite FaceCheck, despite Double Date, and despite management literally forfeiting $60 million in revenue to appease users, the Tinder brand is fundamentally and permanently broken for the next generation.
Brand rot. Irreversible cultural decay.
Exactly. As we discussed earlier, consumer social apps are entirely dependent on network effects, and network effects can violently work in reverse. If a social app completely loses its cool factor, if it becomes culturally synonymous with toxicity or desperation among the youngest demographic, it is almost impossible to buy that reputation back, regardless of how much capital you deploy.
It's like trying to make fetch happen.
Right. If Tinder is permanently impaired, then Match Group is essentially a melting ice cube. No amount of share buybacks or financial engineering can save you from the eventual collapse of the core cash-generating engine.
Because Hinge isn't enough on its own.
Hinge is an incredible asset, but mathematically, Hinge is simply not big enough yet to carry the entire $3.5 billion enterprise on its back alone.
So let's translate that into an actionable takeaway for the retail listener right now.
If you are currently holding the stock in your portfolio, the data suggests you hold for the capital return. Enjoy the 5% dividend bump and let the aggressive buyback program support the stock price. But you absolutely must establish a strict mental stop loss.
Define mental stop loss for the listener.
A mental stop loss is a predetermined, non-negotiable line in the sand where you force yourself to admit that your investment thesis was wrong and you sell the position to prevent further losses. In this case, your stop loss shouldn't be tied to the stock price. It should be tied to Tinder's monthly active user stabilization over the next 2 to 3 quarters.
They promised it would stabilize.
Management promised Wall Street they would stabilize the MAU by the end of 2026. Hold them to it. If we get to Q3 or Q4 of this year, and Tinder's MAU is still actively declining by 9 or 10% year over year, the turnaround thesis is officially dead. The medicine isn't working. You sell.
And if you are on the sidelines, considering buying fresh today,
recognize exactly the mechanics of what you are buying. You are buying a 37% margin cash machine, but you absolutely must have the psychological stomach to weather a completely flat top line for all of 2026. You are buying the dip on a highly distressed asset supported by strong cash flows. You are not buying a momentum tech stock.
That is incredibly clear and deeply actionable.
Good.
But before we wrap up this deep dive, I want to pull on one tiny, almost throwaway thread from the Q&A section of the earnings call that absolutely blew my mind.
Okay, what was it?
And frankly, it terrified me just a little bit regarding the future of this entire industry. It centers on a brand new feature they're currently testing called chemistry.
Ah, yes, their integration of advanced generative AI.
Yes, they mentioned it almost casually, but the implications are staggering. The CEO explained that the chemistry feature allows a user to grant the Tinder app direct access to their phone's native camera roll.
Their personal camera roll.
Yes. The AI then scans your thousands of personal photos. It draws out incredibly deep behavioral insights about your lifestyle. Like, do you hike? What kind of food do you take pictures of? Do you travel internationally? Do you have pets? What is your general aesthetic?
It just absorbs everything.
It analyzes all of that raw, unstructured data, matches it against the camera rolls of other users, and delivers a hyper-curated, highly accurate match. It basically delivers a single drop of a profile to your screen, rather than forcing you to swipe left or right through 100 random people.
The mechanics of that feature represent the ultimate technological solution to the swipe fatigue we spent this entire time discussing. Instead of the user doing the exhausting manual labor of sorting through profiles, the artificial intelligence does the sorting instantaneously based on a deep, somewhat invasive algorithmic scan of your actual unvarnished personal life.
And this leads me to a final provocative thought for you, the listener, to chew on as we close out. We started this deep dive exploring the mechanics of a corporate turnaround. Match Group built a multi-billion-dollar global empire over the last decade based entirely on the gamification of dating.
Right.
The swipe mechanic is their primary economic mode. It generates massive time on app metrics, it generates millions of ad impressions, and it frustrates users just enough that they eventually pay for premium filters to bypass the friction.
The interface functions exactly like a casino slot machine.
Exactly. But if artificial intelligence eventually masters this chemistry feature, if it does the matchmaking instantly and perfectly by scanning our camera rolls and saying, you two are a 99% behavioral match, skip the swiping and go on a date, then the actual time spent engaging with the app drops to near zero. So the existential question is this: does AI ultimately destroy the very swipe-based monetization model that built Match Group in the first place?
That's a huge question.
If the product works flawlessly and instantly, does the economic model collapse? Will Match Group be forced to invent a completely new way to extract value when the swiping fundamentally stops?
It is the ultimate innovator's dilemma for the entire consumer social category. If the AI is perfect, the app truly is designed to be deleted.
And it will be deleted very, very quickly.
It is a fascinating technological horizon and something we will absolutely monitor closely as this tech rolls out.
Absolutely.
Thank you for joining us on this deep dive into Match Group. As always, keep a close eye on the leading indicators, track the MAU stabilization, watch how they deploy that App Store cache, and remember to always look past the corporate narrative and focus on the underlying mechanics of the numbers. We will see you next time.